If the collapse of 3 US banks earlier this month was a failure of management, what went wrong with the federal oversight? Lawmakers this Tuesday grilled 3 of the main banking guardians: the US Federal Reserve, the Treasury Department, and the Federal Deposit Insurance Corporation.
The Fed, the US central bank, pointed the finger at Silicon Valley Bank, or SVB.
The picture that has emerged thus far shows SVB had inadequate risk management and internal controls that struggled to keep pace with the growth of the bank.
Silvergate, SVB, and then Signature Bank collapsed within days of each other, raising fears that the global banking system was on the brink again after the 2008 global financial crisis. SVB lost nearly $2 billion when it sold assets whose value had dropped after the Federal Reserve began raising its benchmark interest rate to lower US inflation. When customers were alerted to those losses, they withdrew $42 billion in just one day, a classic bank run that SVB couldn't handle. For lawmakers, it was both a management and oversight failure.
Banks should be prudently managed, should be mindful of the full scope of risks they face, should diversify across companies and products.
There was a clear supervisory failure. Our regulators were simply asleep at the wheel.
Silvergate and Signature suffered similar mass deposit withdrawals, having suffered significant losses in the cryptocurrency boom and bust.
But if these banks invested poorly and federal regulators are also blamed for not keeping a closer eye on what they were doing, then perhaps lawmakers also need to consider their own role in easing stringent regulations imposed after 2008 that were supposed to make banks safer.
The FDIC insists no taxpayer money has been used to cover SVB and Signature customers. Even so, the FDIC estimates the cost of these backstops at more than $20 billion. And there are concerns that even if the cost is shared by all banks, they'll just pass it on to customers with higher charges. Owen Fairclough, CGTN, Washington.